Hello and welcome, I'm Sriyash Maheshwari and you are watching Last Tick here on News 9 where we break down the day's action on Dalal Street. And Indian markets, they witnessed a lackluster but volatile start to this week as investors geared up for a jam-packed schedule ahead with a bunch of central banks, including the big one in the US, set to reveal their policy decision. Now, most analysts and experts that we have been talking to are not expecting the Fed to go for a rate cut this time around, as inflation continues to remain, ahead of their comfort zone. But what Mr. Powell says is what's got everyone on the edge. I mean, if he leans towards the hawkish side in his commentary, we need to watch out, and because markets could take a hit, including ours here in India. But if you look at the session today, Nifty ended pretty much where it started, inching up just 32 points from Friday's close. However, there was a lot of volatility during the day as the index moved in a 200-point range. But if you look at the last two sessions, the index has seen resistance around that 20 to 120 odd levels, and this could be a key level to break on the upside. On the other side, support is actually more well defined. In the last 4 or 5 sessions, Nifty has taken support around that 21,900 to 21,920 mark, and this could provide a crucial floor for the market in this correction. So as long as the market is trading in this range, all bets are on, anything could happen. But once we break out of it, look for directional opportunities maybe. But moving on to the broader markets, the situation looks rather unclear there. Late last week, we saw a strong recovery in the mid and the small caps, especially in the small caps. But the indices reversed course today. But that said, the cut was not significant. And more importantly, both indices did not break the low of Friday. So unless those levels are broken, recovery could still be on the cards, although it could be a slow and volatile recovery, not like the past few instances where the recovery would be almost immediate and we would hit record levels once again. As for the sectors, auto, media, metal and realty indices posted gains of over 1% on Monday. Metal stocks particularly was the strongest segment of the market. Those stocks were buoyed by China's robust industrial output growth. China's January-February industrial output expanded by 7%, surpassing estimates of about 5.2% growth. Nifty Bank, on the other hand, ended flat but still managed to defend 46,500. Remember, that's a crucial level for the index. IT stocks, on the other hand, ended with deep cuts, and that's probably because of this lack of uncertainty regarding the policy outcome. FMCG stocks also ended lower. With that, let's also bring on board Mr. Rohit Srivastava, founder and market strategist at indiacharts.com to get his views. Thank you for joining us here on News 9, Rohit. It's going to be an eventful week for the financial markets. Several central banks will come out with their monetary policy decision. And while most are leaning towards, easing things up, one central bank could actually go on and hike rates. Bank of Japan is expected to, end its negative interest rate when it comes out with its policy decision on Tuesday. And this will be the first rate hike in the country in 17 years. Now, this of course means a stronger yen against the US dollar, but this could also mess up with something we call a carry trade. A carry trade is when investors borrow in a low interest rate regime like Japan and invest in a higher interest rate regime like India, to profit from that interest rate differential. So if carry trade goes out of the picture, that could perhaps impact FII flows coming over the next few months, Rohit?
So it's an interesting take. We have seen talks of carry trade even in the mid 2000s. It didn't end up having a very significant impact. The last time the carry trade risk played out was probably somewhere in the 90s. So it's always a reminder that something could happen. But it is a weak currency that people try to borrow into. And if the yen starts to strengthen, whatever borrowing has been done in yens can somewhere get questionable. But more than just the carry trade itself, what also aggravates the situation is if the markets themselves are in doldrums, or if you have a strong dollar environment along with a strong yen. I think that would be a bad mix, because typically a strong dollar rising bond yields is a serious risk off environment. If you have a weak dollar which is fueling, liquidity in other parts of the world, and then you have a strong yen scenario, it may not be so significant. But if you have a strong yen and a strong dollar, then that's definitely bad news.
All right, and while the markets are clearly, I mean, they are still not in the doldrums yet, but the three factors, as investors like to put it, the three horsemen from a global perspective, they had turned against us, like the 10-year US Treasury yields, the dollar index, and crude oil price. I mean, crude oil price in particularly, they have spiked by over 5% in the last 5-6 sessions or so. Brent crude is now above $86 a barrel. I mean, that's the highest level since late October or early November of 2023. I mean, Rohit, is that going to be a problem for us in the coming months, and especially the emerging markets as well, not just India, emerging markets as well?
Yes, so you see, what is really happening here is this is a fight between what we call narratives and reality. Narratives are what the expectations tell us, what is being communicated to us through the media, and then there is reality of what is really happening. So let me just broaden that a little bit. On the one hand, you have the Federal Reserve trying to slowly send out a communication that they are getting closer to the end of the hiking cycle. Now, what happens is markets tend to discount things months and months in advance. Now, if you start telling the market that, hey, I'm done, if not now, maybe 3-6 months down the line, I'm done, the market starts discounting that by rebuilding on what we call the reflation trade, which is, let's weaken the dollar, let's buy oil, let's buy commodities. Copper prices also have gone up recently along with oil.
Right.
And so once you get the commodity trade back, it's the market betting on, well, if they're going to cut rates, they're going to get, everything, prices of everything going up. The bad news is that by betting on that, you will actually bring back the very inflationary forces that you are trying to kill. So the communication itself is self-defeating. I'm not sure how this ends, but right now, because it has been communicated so much, the markets are ignoring the idea that bond yields are actually rising along with rising oil prices. So the bond market is saying something different. It's saying, well, if you're going to inflate, then we are probably headed higher as far as interest rates are concerned. And that is the catch. So that is not good news. But then US equities are sort of ignoring that right now, because the communication is very, very strongly that they're going to cut rates. So they're ignoring bond yields, but going by the narrative that, no, it doesn't matter, rates are coming down.
So, I mean, as far as this policy decision goes, I mean, I think broadly, not many of us are expecting a rate cut this time from the Fed. But, what will you be paying close attention to in Mr. Powell's commentary?
So, it's all going to be about whether he changes anything. I mean, the thing is, with this particular meeting, he's already said most of the things that, okay, I'm not going to do anything in March. You're probably going to get one more, you're going to get at least a cut somewhere later in 2024. So he's already mentioned that in the last two meetings. So that sort of leaves very little new to expect, except that, okay, let us watch where the dot plots move in terms of what are the other people on board expecting in terms of the rate movement. Will that shift upwards or downwards a bit? And if it shifts too much, then will it end up being a negative for the market? So that's about very little communication that we'll probably be reading into when it comes to this particular meeting. Everything else appears to be discounted.
All right. And, focusing back on our markets, in the last couple of weeks, I think since the last time we spoke, a lot has been made about the valuations of the small and the mid caps. I mean, they have corrected quite significantly. I mean, last week was one of their worst week in nearly 15 months. But after this correction, how is the valuation of the broader markets looking?
Well, I don't think a small correction really sets you back to a level which makes you comfortable. The reason people are finding comfort is not that the valuations are good, but that the liquidity flows are strong. Everybody is banking on the idea that if you have SIPs at 14, 15, 16,000 crores a month, then valuations will remain elevated and any correction will get bought into, and therefore do not expect lower valuations. But if you take a 10, 20-year chart of valuations, you've probably seen the small cap index P ratios gyrate all the way back up to 80, 90 times and then go all the way down to 20 times. And it's been a pretty wide range. We saw that between 2018 and 2020 as well. We've seen that between 2008 and 2009, and again probably in 2013. So will we again go to the bottom end of the valuation range? Typically, you would expect that to happen. The only counter argument I think the bulls have right now is that no, there's so much SIP flow. Apart from that, there is no argument to really say that valuations are cheap. They're not cheap. They're still expensive.
All right, valuation are expensive, and you mentioned that the correction has not been to the quantum we were expecting, the broader markets was expecting. But are you concerned of this evolving into a 2018 sort of a scenario, where the small caps gave up 45%? Because if we are to draw parallels, there are a few between then and now, sir.
No, there are not a few. There are many parallels. And if I'm someone who's a student of history and expects history to repeat, then I would definitely expect a repeat of not just 2018, but it's also 2008. Each of these occasions, one thing that we have repeatedly seen over and over again is that the ratio, so this is one data point that I have been putting out, is the ratio of the total futures open interest, that is the combined index and stock futures open interest, and we divide it by the index. We do that just to normalize the ratio. The first time it was at around 18 times the Nifty was in 2008. It came close to that again in 2011 and then in 2018. And now we are at the same level. So basically what it's trying to tell us is that when there is excessive buying into the futures market, it also coincides with excessive bets on the mid and small caps, because the mid and small cap cycles have coincided with that data point. And that is where we are. So there is an excess, doubt, in many different ways we can measure it. The fight really is on debating whether the excess will unwind or not.
All right. And sir, before we let you go, I was reading this interesting report which said that, promoters, they are buying up shares in the mid and the small cap sector. I mean, trying to take advantage of this recent dip. I mean, a month ago, it was the opposite. More people were selling, more promoters were selling than buying their own stake. I mean, now, some might take this report as a signal that, these stocks are probably available at an attractive valuation at a steal. But I mean, I'm not too sure here, because, if the amount that they are buying isn't that substantial, I mean, it could just be that, a signal, not a real indicator of undervaluation, sir. What are your thoughts on this?
Promoters, it has been said, not just by me, but some of the best investors in the market, that they are the last people who know what is happening in their company. They can't take a long-term view of things. So I would really not go by their buyings and sellings. You would have to go a little deeper than that.
Fair enough. So maybe we should not read into all these reports. That's what I think you are alluding to. Sir, thank you for joining us here on News9. Always a pleasure speaking with you.
Thank you. Thank you for having me.
And with that, it's a wrap on this edition of Last Tick. Thank you for watching.
Start with the end in mind. You need to know where you want to reach. Every morning that we wake up, we are exercising our choice. The destiny is decided. The results are known that I'm going to win. Life of a goalkeeper is something which has always intrigued me. When you come into a stadium, this is the highest level of pressure. When I set out to do something, I decide in my mind that failure is not an option.
What you feel very strongly about, those are the stories to tell.
I have a mind which is absolutely restless. Mind and body are entangled sensations. That brings me back to golf. It's an amazing game.
This is not a perfect game. You only learn from them.
If you have a formula to a success, then you can replicate it.
I feel this is my first step. I'm starting now.
The winner is first born in the mind. I think, therefore I am. We are all about our mind.
This and more. Streaming on News9 Plus. Subscribe and get free vouchers.
Hello and welcome. You're watching Business Plus. We're bringing you stories from the world of business policy and economy. The top story that we're tracking at this hour, government has rolled out a new electric vehicle scheme which is likely to attract likes of Tesla, BYD, VinFast and global OEMs to India. The new policy for battery-driven passenger cars is expected to give a fillip to foreign original equipment manufacturers as well as promote India as a manufacturing EV destination. The new policy mandates global companies to invest a minimum of 4,150 crore rupees in India. The companies will be allowed to import up to 8,000 EVs in a year at a lower import duty of 15% on cars costing $35,000 and above. The policy will allow them 3 years to set up local manufacturing for EVs with at least 25% components sourced locally and 50% localization by the 5th year. India levies at the moment, remember, a tax of 70 to 100% on imported cars depending on their value. The move comes at a time when automakers in India likes of M&M, Tata Motors, Hyundai and India's biggest auto player Maruti are boosting their electric vehicle production as well as portfolio. To talk more about the prospects of EVs and what does the new policy mean, Shashank Srivastava, Senior Executive Officer at Marketing Sales, Maruti Suzuki, joining us very shortly. With me is Krishna Kumar here in the studio. Krishna, a very good afternoon. A very important policy that was in the making for a while now. Whether Tesla will come, will not come, was a matter of debate. I don't think it's a matter of debate anymore, because India is a lucrative market and it has literally rolled out a red carpet for Tesla.
Well, absolutely. There is no doubt in my mind that, India is now, apart from all the work that's gone into making India into a semiconductor hub with the first, fab plants being set up, 3 of them. In fact, now India is making its ambitions and its intentions clear that India wants to be an electric vehicle manufacturing hub. And that's the reason why you have this latest policy. And as you rightly mentioned, everybody from Tesla to the Vietnamese company called VinFast, everybody wants to, enter India. BYD, in fact, wants to dominate the Indian market with the Chinese electric vehicle maker. So the hope is that this policy, with the kind of import duty reduction from 70 to 100% to just 15%, attracts them. But my question here, Shweta, is this. The reduction of import duties is meant for cars with a value of $35,000. That's costs plus insurance plus freight, which roughly works out around 29 lakh rupees, if I'm not mistaken. So which means that only cars that cost 29 lakh rupees and above will be eligible for this kind of a discount, in terms of duties from the Indian government. But, not very long ago, we heard rumors or we heard reports that Tesla is planning to launch a 20 lakh rupee electric vehicle here in India. And at 20 lakh rupees, a Tesla for 20 lakh rupees in India makes it extremely attractive and, would be selling like hotcakes the moment it hits the market. But that 20 lakh rupee Tesla is not eligible for any kind of discounts as far as the import duties are concerned, according to this new policy. So I'd be interested to know, how the market dynamics will play out for electric vehicles and their price points. Because even now, your electric vehicles are selling at anywhere between a 25 to 30% bare minimum premium to